Hi, in this video, we'll be talking about the difference between mutual funds and ETFs, the fees associated with them, as well as the best way to do research. Stay tuned. So, what is a mutual fund? A mutual fund is a type of financial vehicle where a bunch of investors pool their money together to buy securities such as stocks, bonds, and other assets. One way you think about it is if me, you, Bob, Keisha down the street all put our money together to buy Apple, Amazon, Tesla, and we agreed to share the profit. Except a mutual fund is at a much bigger scale with people all around the world. And a mutual fund has something called a fund manager or a money manager. This is the person that has full autonomy on when to buy and sell a particular stock to try to maximize capital gains. The obvious benefit of a mutual fund is that when you buy one share, you are instantly diversified because you're essentially buying a bucket of stocks. And the other thing, you have a person that's doing all the research for you so you don't have to. However, if you've ever taken Economics 101, then you know there is no such thing as free lunch. You are paying for that convenience in the form of something called expense ratio, which is something we'll talk about more later in this video. Another thing about mutual funds is that a lot of times you need to have a minimum to invest. When we look at a couple of Vanguard mutual fund, you see that there's a minimum of $3,000. So that means if you don't have that $3,000, you can't even buy that mutual fund. And another drawback, which I think in my opinion is the biggest drawback, is that you can only trade your mutual fund once a day and it executes at the end of the day. So if something is happening in the stock market, like back in March with the whole Rona situation, and you want to sell your stock as soon as possible, you actually would have had to wait till end of day to execute that trade. An exchange traded fund or ETF is pretty much a hybrid between mutual funds and individual stocks. Just like mutual funds, it is a basket of stocks, so you instantly get that diversification. But unlike mutual funds and very much like individual stocks, you can actually trade it throughout the day. And because a lot of times ETF don't have active management, the expense ratios tends to be a lot lower than mutual funds. In addition, with an ETF, you can actually buy one share. So you don't need to have a minimum of $3,000. So if an ETF costs $20, then that's all you need is the $20. Now, you're probably thinking, why would anybody want to have a mutual fund over ETFs if ETFs provide the same diversifications but cheaper and more liquid? And honestly, I would agree with you. But there are people like my friend Karl who loves his mutual funds. As a matter of fact, he has VT Sachs, which is a mutual fund that tracks the entire market index, and I have VTI, which is an ETF that tracks the whole market index. So it does the same thing, except his is a mutual fund and mine is an ETF, and we argue all the time. And his argument is that with mutual funds, you can invest all of your money, assuming you have the minimum. So for example, with ETF, if a particular share costs $150 and I have $299, then I can only buy one share because I'm missing $1. But with a mutual fund, as long as you meet the minimum, then you can invest all that $3,000. And honestly, that's a fair argument. When investing, you want your money to be working for you. However, my argument to him is if the sky is falling and the stock market is going along with it, I can sell my shares and take my money and run. Like, you are literally stuck like Chuck because you cannot sell until end of day. So now let's talk about active versus index fund. And active is a portfolio that has a manager that's actively doing trades on your behalf. And an index fund is basically very passive and it tracks a market index. So for example, VTI is Vanguard's total market index. It pretty much tracks the total market. So if the total market is up, then your ETF is up. If the total market is down, then your ETF is down. And when you have index funds, because you're buying the good with the bad, the most you could do is average out. All right, so let's talk about these fees, because that's the part your financial advisor is not going to tell you. They'll tell you how this fund is doing so well and you get 12% or whatever sales pitch they have, but somehow they always forget to mention the hidden cost or the cost that's going to eat away at your profit. So let's talk about it. The first one we have is a sell charge, and you often see it as either a front load or a back load, and it's usually between 3 to 6%. And what that means is that's the money that's taken from the top. So before your money is even invested, they're taking a percentage out. So basically, before your money even get invested, you're already down 3 to 6%. Honestly, guys, I want to make these videos as non-biased as possible. I just want to give you guys straight facts so you make your own smart investing decisions. But if a so-called financial advisor approach you and trying to sell you a mutual fund with a front or a back end load, kick him in the balls and run, okay? Because that's what I wish I did. Early in my investing journey, I thought I would hire a financial advisor, so I found someone. It was recommended to me by a friend, and he was under this whole Dave Ramsey umbrella. So I was like, okay, this is somebody I can trust. And he offered me a mutual fund that had a front load of 5.6%. So every month I was investing $1,000, and before that $1,000 was ever invested, they will take $56 off the top. I can't even tell you how much money I've lost because of that. So please, please, please do not make the same mistake, please. The next thing we have is an expense ratio, which we mentioned earlier. That's pretty much the management fee, and it's going to vary from fund to fund. Vanguards have the lowest expense ratios on their ETF, usually around 0.04%. So that means for every $1,000 you invest, you're only paying 4 cents, which is actually a pretty good deal if you think about it. A redemption fee is pretty much a don't sell early tax. So usually it's like if you sell before 30 days and sometimes even 60 days, then they will charge you that fee for selling out early. All right, so pop quiz. What do you do if a financial advisor wants to sell you a mutual fund with a front end or a back end load? A, say, why thank you, sir. Or B, kick him in the balls and run for your life. And it better be B. All right, so we're here at my desk, my very, very long desk, and I'm gonna show you guys what to look for when considering these mutual funds. So you wanna go to your browser, and you could just pretty much type in Vanguard. So instantly you kind of already know that's what you're looking for, because it says mutual funds and ETFs, also IRAs and 401ks. So we're gonna go ahead and click on it. Depending on when you're watching this video, the interface might be different. They do tend to change it every now and again, but the functionality is the same. So what you have to do is look for something that says personal investors, click on that. And from that page, there's always gonna be something that says investing or something to that effect. And from there, you can just go ahead and click on Vanguard's mutual funds. And we're gonna browse Vanguard funds by asset class. So from there, it gives you a bunch of different options. Money market, I think it has bonds, but we want to look for stocks. So we're gonna keep scrolling down and down. All right, so here we have US stocks funds. And for this one, we're gonna do VT Sachs, if I could see it, VT Sachs. Maybe I'll just search for it. Oh, there it is. So we can go ahead and click on it. If you want to know what type of stocks a particular fund has, all you have to do is kind of scroll to the bottom where it says holdings. Maybe I went too far. Yeah, so it'll say holdings, and it'll give you the initial top 10. Here, Apple is number 1, because as we've talked about, Apple has the largest market cap, so it is actually in proportion to how big and small a company is. So Apple is the biggest company, so therefore Apple is number 1. But let's focus more on the fees, because that's going to be the make and break of your investment decisions. So instantly on top, you see where it says expense ratio, it's 0.04. What that means is for every $1,000 you invest, they're only taking out about 4 cents, which is actually pretty cheap. And then here we have our minimum investment of $3,000, like we talked about earlier. And if you want to see more stuff, you can go ahead and click on fees and minimum. And then here, there's no purchase fee, which is the sales fee I was talking about. So that's going to be your front end and back end load. So they don't have that, which is good. Redemption fee, they don't have that. And 12B1 fee, which I don't think I mentioned, but that's pretty much marketing fee. So those paper they send you in the mail to tell you how great the fund is performing, they're actually charging you for it. All right, so if we go back to overview, let's take a look at the ETF counterpart real quick. So this is VTI. As you can see here, even with VTI and VTSAX tracking the same index, the ETF is instantly cheaper by 1 cent, but nonetheless cheaper. And also you can see here, there is no minimum amount. And if we go to fees, as you can see, it doesn't have any redemption fee or any sales load or any of that 12(1)B crap. So none of that. So with ETFs, you just get the expense ratio and that's it. Now, let's take a look at the fund that bamboozled me. I mean, I'm not salty. Are you salty? I'm not salty. So here, if we go to American funds, and I actually really wanted to show you guys this because a lot of times I'm realizing that's the fund that financial advisors will recommend to people. And I want to make sure I show you guys some of the things that they may not mention, or even maybe they mentioned it and you might not understand. So here we have a variety to choose from. I'm just going to go ahead and pick New Perspective because I think that's the one that I had. So let's check that one out. You click on it, and just like Vanguard, you can actually see the asset mix and all that stuff, but we don't care about that right now. So if we go all the way down to fees and expenses, here you can see that this is significantly more than the Vanguard. Like the Vanguard was 3 cents, this is $3, right? And then it also has this other expense that I don't know about, 0.14, and then the 12B1, 0.25. But honestly, I don't even know what this is. But honestly, this is not even all of it. So if you really truly want to see the fees, you actually have to look at the prospectus because they're not dumb enough to put it on the first page. So let's go ahead and click the prospectus right here and make this bigger. All right, so this is 98 page. We're not about to scroll through 98 page, so we're just gonna go ahead and search for what we're looking for. Yeah, there we go. So we're looking for a management fee basically. Once you get management fee, it tells you all the other fee. Right here, as bright as day, maximum sales charge load, and it is 5.75%. So even a little bit more than the 5.6 that I was paying. And in addition to that, you still have your management fee, distribution, other expenses. So a lot of times financial advisors like to say, oh, this fund returns 12%, which is great, but okay, it's 12%, but once you subtract the 6% and then these other percentage, you're pretty much left with about 6%, which is not even average for a typical index fund. So you're honestly, in my opinion, you're much better off just getting a ETF. All right, thank you guys for watching. Don't forget to leave a like, and if you haven't subscribed, definitely subscribe, and I'll see you on the next video.